What if I told you that there's a way where you can reduce your taxes right now and also build your wealth simultaneously for your retirement? Sounds too good to be true, but it is possible here in Canada by using one simple account known as RRSP or Registered Retirement Savings Plan. So let's just jump right in. What's up, everyone? Welcome back to my YouTube channel. If you are new here, I'm Chandelier and I make personal finance video here in Canada and talk about budgeting, investing, and savings. Not only that, I also share my own journey to financial freedom, which I'm pursuing right now, and I talk all about my income, saving, and investment, since this channel is all about transparency. So if you're into that kind of content, then please follow this channel. Today, I'm going to talk about one of the most important accounts available to Canadians, known as RRSP. I will break down everything you need to know about it, like what is RRSP, how much you can contribute to it, what kind of tax benefits and investment options are available to you for that account. Also, stick till the end to actually know how you can withdraw all of your money from your RSP and save up for your retirement and use it wisely. So, let's not waste any time and start. So, let's start with what is RRSP. RRSP stands for Registered Retirement Savings Plans, and it is also a tax advantage account here in Canada where you can grow and invest your money tax free until you retire, and it is designed specifically for your retirement. So let's just say you invest some amount of money in your RSP, then you will get an immediate tax deduction right now, which means you pay less taxes today. However, when you actually withdraw your money from your RSP, when you actually retire, it will count as a taxed income and you have to pay tax at that time. Let's talk about the deadline and the contribution limit for RSP. See, the tax season is just around the corner, and so is the deadline for RSP, which is on March 1st, 2025. So you still have 2 weeks left to contribute in your RSP account to lower your taxable income. Let's talk about the contribution limit. It accounts as the 18% of the annual income that you earned from the previous year. So it depends upon person to person how much they earned last year, and RSP contribution comes to about 18% of that. Not only 18%, CRA has its own limit about how much maximum you can contribute to an RSP, which is about $31,560 for the year of 2024. Moreover, if you have an employer which contribute in your pension plan, then that amount also accounts towards your RSP and overall reduces your contribution room as well. So make sure you keep an eye on it as well. And let's just say you are not able to max out your RSP this year. So don't worry about it since that amount gets carried forward every single year. So you can contribute more. Now you know what is an RSP, what is your contribution limit, and what kind of tax benefit that you can get by opening and investing your money into this account. So let's talk about what kind of investment options are available to you to grow your money in this account. Let's start with stock and ETFs. You can buy any stocks or ETFs you like into your RSP, but there is much more risk towards it. So if you are planning for long-term growth, then stock and ETFs will work great for you. The next is buying bonds or mutual funds to it. Now, bonds and mutual funds provide stable income and are like passive income and have much less risk. So if you are on your late 40s or you have about significant amount of money saved and you don't want to lose it in the next decade, then this make more sense. At the end, GICs has much more lower return rate, but they are very safe. So technically, it will depend upon person to person what they want to do with their money, what kind of investment they want to buy into their RSP. But in general, if you are younger, like in your mid 20s or 30s, it makes more sense to buy more stocks and ETFs since you can bear the market fluctuations over a period of time. But if you're someone who is just about to retire or like in their 40s or in 50s, then you will already have a significant amount saved and you don't want to lose it over a market fluctuation in the next 10 years. So GIC or like a more stable portfolio like heavy bond or mutual funds will make much more sense for you. Hope that clears this up. Since you have stuck till the end, let's understand what happens when you actually start withdrawing your money from RRSP. Now, by this, you should know that whatever withdrawal you do from your RRSP will count as a normal income and you will get taxed on it. So it is better for you to withdraw it strategically. Let's talk by case to learn how you can withdraw your money and how it can affect you in different cases. First, let's say you have not completely retired yet, but you start withdrawing your money from RRSP. Let's take it as an example. Let's say you earn about $100,000 and you start withdrawing $10,000 a year from your RRSP. Now, government will put a withholding tax on your withdrawals from your RRSP, which is about 20% if you withdraw from $5,000 to $10,000. So if you withdraw $10,000, you will only get 8,000 and 2,000 will be taxed by the government. Now, when you actually file your taxes the following year, your total net income is not $100,000, it is $110,000. So you have to pay taxes on that. So you might end up paying more federal taxes when you actually withdraw $10,000 from your RSP, which is not great. So this is the first case. Let's talk about the second case where you're actually retired and you have no income at all. Let's just say you're in your late 65, so you're 66 years of old. You start withdrawing $10,000. So government will still put a withholding tax on it. So you will get $8,000. However, when you file your taxes next year, since you have no income, you come under the personal basic amount, which is less than $15,000 a year, since you only withdraw $10,000. So government will give you a refund of $2,000, which they took while putting a withholding tax on it. So you will get a full $10,000, but only next year. Still, it is not good since you're getting paid only $8,000 when you actually need it, and you will get your refund next year. Third is the best case, is that you have to convert your RRSP into an RRIF account, which is Registered Retirement Income Fund. In this account, you cannot invest anymore, you can just withdraw. But if you withdraw the minimum amount set by the government based on the amount you have, you don't have to pay any withholding tax. So, for example, you have $200,000 in your RRSP, and I believe the minimum amount is about 5.28% of it, which comes at about $10,000 every year. So if you withdraw only $10,000, there will be no withholding tax. However, you will pay normal taxes on it when you actually file it next year. Still, it will be under $15,000, which is the personal basics amount, so you will get full refund, but just to make sure. So the main goal is to not pay the withholding tax, and you can achieve it by converting your RRSP account into an RRIF account, which gives you that benefit. Now that's gonna wrap up this video about the RRSP. RRSP is one of the most advantageous account that you can open right now for your retirement. Just make sure that you contribute before the deadline to get the maximum refund and get benefited from that tax-free growth. If you really like this kind of content, then hit the subscribe button and like this video. And if you have something in your mind, then do hit it in the comment section and let me know if you're going to invest in your RSP today. So until next time, stay financially savvy and peace.